So I think we need to start this video with a disclaimer. If you do not want to make more money, if you do not want to better your and your family's financial futures, don't watch this video. Click off this video right now. I promise you, you are going to waste your time. And there's nothing worse than wasting time. If you are someone that does want to do those things, you want to make more money for yourself, maybe for your family, maybe you want to do good things with that extra money. Help out people. Who knows? Whatever you want to do with your money. Well, this is the video I think you really need to watch in its entirety. Because there's one thing in particular that moves stocks, that makes or loses you money. It's not earnings. It's not conflicts around the world. It's not the government spending more money or raising more treasury bonds. It's none of that. There's one thing. There's good and bad news. Bad news is, if you're a near-term thinker, the markets could get worse from here and get a lot worse from here. Good news is, it probably won't take all too long for things to get better. If you're confused, well, I don't blame you. We're going to get into it here in this video. I've spent a lot of time gathering this information, so hopefully it all makes sense by the end of this video. And we will summarize it along the way as well as the end of this video, just so everyone fully understands exactly what is said here. So, we're going to go ahead and get into it. Tesla stock, if you are a Tesla stock investor, this is particularly important for you, especially for you, because there is a huge opportunity right on the horizon for Tesla and for Tesla stock investors. If you are one of those and you like Tesla stock, you want to stay up to date with Tesla stock or just keep up to date with the broader markets, maybe a mixture of the two, hit the like button as well as subscribe to the channel. We'll keep you informed twice a day, every single day. Now, here in the short term, things could get much worse for our markets. We've seen this coming for a while. I started talking about this crash, this correction, back in August of this year. We've been forecasting this for a while, and it seems like it's played out almost perfectly. But it could get much worse from here. And that's really part one of how you can make a lot of money in this particular next 3 to 6 months or so. Because this is probably, I would put my money on the line, and I am putting my money on the line, to say this is the last big drop you're going to see in the markets. And by big, I mean you could probably go back to your October lows. That could happen. Maybe it's not that extreme, or maybe it's much worse than that. It's hard to say exactly. Predicting the markets is, one of the hardest things you can do, period, let alone anything else. So in the near term, there's a lot of different things that are going on. You have Middle East crisis, conflict, whatever you want to call it. I think that is becoming less of a factor in our markets because it's not escalating from here. So I think the markets are about to get over that one pretty quickly. The big problem we're having lately is earnings. Earnings for big tech have actually been really good across the board. You haven't seen a big tech stock have bad earnings. Google was down 10% following earnings, and their earnings were actually phenomenal. They barely missed on their margin and barely missed on their cloud business, whereas they beat on everything else. Their free cash flow was expected at $17 billion. It came in $5 billion higher than expectations, around $22 billion. Wall Street didn't care. Wall Street was focused on one thing. It was basically an excuse. Now, what do you mean it was an excuse? The one thing that we do not have in our markets is liquidity. There is zero liquidity. And that is what moves stocks. It's not earnings. It's not any of these other things, at least in the past 20 to 30 years. It's all about liquidity. There's really two different ways to think about liquidity. Number one is the Fed. Ever since the 90s, the Fed has been doing what's called quantitative easing. That means they've been pumping money into the system. It's as simple as that. Via buying treasuries most of the time, or just bailing out the markets whenever there's a troublesome period, like back in March, the Fed injected $400 or so billion into the markets. And what happened since then? Well, stocks went up big time. If that did not happen, 2023 would have looked a lot different. At least from March until now. We probably would be much lower, and I think that's a fair assumption. The second way to think about liquidity is investor psyche. A couple different things along those lines as well. Obviously, what is the state of the economy? Is the economy doing well? Is the economy doing poorly? I think you could argue right now the economy is doing pretty well. We just had almost a 5% Q3 GDP report, and the consensus is we're going to have a soft landing. That's the consensus. Now, do we or do we not? I don't think it matters. I don't think a soft landing or hard landing matters as long as it's not too bad. I think a lot of your market has already priced in a hard landing. Your big tech names have not. And we'll get back to that here in just a moment. That's why in the near term, you probably can see a lot of downside on your index level. Your SPY, your QQQ, they could get obliterated. That's true. The rest of the market has already basically priced in a pretty strong recession next year. But along the lines of investor psyche, you also have competing assets like treasuries. Treasuries compete with stocks. It's been a long time since you have been able to get over 5% on a treasury. And some people are taking advantage of that. So it's taking money away from what would otherwise be in the markets. And you can see that here. We just had the largest inflow on record to long-term treasury funds. You just seen within the last couple of weeks, almost $6 billion bought in treasuries. Whereas back in 2017, 2018, 2019, 2020, you were basically around zero. There really wasn't much money flowing into treasuries, even throughout, some parts of 2022, 2023. It goes up and it goes down, but the clear trend, is obvious. It's been going higher. I guess if we could just draw a line here, right? The clear trend before was either sideways or even down heading into 2019, 2020, and it's been a clear trend upwards ever since. That has been, again, driving up yields, because when investors sell treasuries, yields go higher, but someone else has been selling treasuries as well, the US government. This is the Treasury Direct website. This is the last 20 bond auctions that you have seen. And the allotted high is right here. That's basically where the auction starts. Right in here, this column. And your actual investment rate is where that auction ends. So investors have been driving yields higher. And the psyche is right now, where do they go? The higher they go, the more appealing it is to buy treasuries and to not buy stocks. You also have the Fed, which is rolling off their balance sheet. The Fed's balance sheet peaked out back here in about May of 2022 with total assets of $8.93 trillion. Today, the Fed's balance sheet sits at about $7.95 trillion. So the Fed has sold over $1 trillion, almost $1.5 trillion within the last almost 2 years now. And there is a very strong correlation between the Fed's balance sheet and stocks over the last 15 plus years, ever since the global financial crisis back in 2008, back when we learned the Fed will just bail us out. The Fed's always going to provide the markets liquidity. And that is something that markets have not forgotten about. Whenever the Fed's balance sheet declines, like back in 2018, 2019, you've seen some very ferocious crashes. I mean, this is the period that we were just looking at when the Fed's balance sheet actually went down. You had what was almost a 10% pullback here, what was a 20% pullback here, and then stocks went higher after the Fed started providing liquidity. Now take a look at this article from October 30th, 2019. The Fed cut rates for the third time in 2019. And just listen to what the Fed said, because it's so different to what the Fed is saying now. They say, quote, "So I think we would need to see a really significant move up in inflation that's persistent before we would consider raising rates to address inflation concerns." That is what Fed Jerome Powell said. He also said, "I thought the goal of the meeting was to try not to force Powell's hand to cut, and I thought the statement we gave on the offset was down that path." He said things that were more balanced. Well, Jim Schaefer, Deputy Chief Investment Officer at Aegon Asset Management, he said that. He also said, "Then I thought he got more hawkish in the meeting, talking about insurance," Schaefer added. But towards the end, he seemed to pull it back a little. The bottom line from Powell is not that they aren't going to cut again, but don't expect it. The Fed always tries to walk this line until they don't anymore. They always try to say, don't expect a cut, and then boom, we're going to cut for the third time, like you seen back in 2019. Now, I think there's obviously different things that are happening now compared to 2019. Inflation is higher. But you really just need to see inflation break. It really comes down to housing. Housing is where the inflation is as of right now. The Fed will realize that. Or, on the other hand, maybe the economy does fall into a downturn faster than what we might think. Considering we just had 4.9% GDP last week for Q3, Q4's expected GDP report is less than 1%. You're actually expecting about 0.7% from the average top and 10 bottom forecast. On the high end, you're expecting around 1.8%. On the low end, you're expecting about 0.8% negative. So it's pretty clear. Q3 was an abnormality. A lot of it was boosted by inventories, by deficits, a lot of things that you might not care about. But bottom line is, Q3 GDP report, it maybe wasn't as strong as the actual number suggests it was. When you take out these other factors, that GDP report would have actually been less than 2%. Now let's circle back to liquidity for just a moment. This is the inflows and the outflows for the S&P and the NASDAQ, or S&P 500 ETF, the SPY, and the QQQ, the triple Qs, the ETF for the NASDAQ 100. This is from September of 2019 through October 26th of 2023. So let's look at some of these numbers. In 2019, the aggregate net flow between the two, it was about $9 billion for the SPY and about $2.2 billion for the QQQ, totaling $11.3 billion. That was the net, and that was, again, a period in time where the Fed really started providing liquidity towards the end of 2019. And what happened towards the end of 2019? Once the Fed provided liquidity, well, you can see that article that we just talked about was in October, right? Let's refresh because I don't remember the exact date again. That was on October 30th. So the markets were already kind of moving up, heading into that Fed meeting, already kind of expecting what the Fed did. But let's see exactly what happened. So from October 30th into the Rona, the SPY went up about 12% just in the course of a couple of months, about 4 months. That was a very aggressive rally in our markets because we finally got some liquidity from the Fed. Now, back to the liquidity chart, or the flows. Maybe it's not a chart. In 2020, you had net outflows of about $7.8 billion. A lot of that was due to that initial drop during 2020, the Roni crash. And let's be honest, a lot of people were fearful throughout 2020. There was a lot of people on the sidelines calling for another, wave of the Rona and for another big pullback, another big shutdown. And you did see your ups and downs here, but people were not convinced that this rally was real at that time. 2021, everyone got convinced. Everyone. And you had net flows of $60.5 billion into the SPY and the QQQ. $60.5 billion. None of these other numbers compare to this. Now, 2022, the Fed started taking liquidity out of the markets again. And what happened? Stocks did poorly. No shocker there. Stocks did poorly. And then what happened so far in 2023? Maybe this might surprise a lot of people. You have only seen net inflows of $2.3 billion. The lowest inflows, like more than 5 times lower than your 2019 inflows. Really, really low. Super low. But what about the return for the SPY and the NASDAQ? Well, the SPY, S&P 500, is up 8.66% for 2023. And the NASDAQ is up a whopping 27.41%. Now wait, how is the NASDAQ up 27% if there has only been $2.3 billion worth of inflows? And this actually does have about $5.6 billion in inflows to the QQQ and negative about $3.3 billion of inflows, or technically outflows from the SPY. It's simple. What's happened to your other, 490 so stocks on the SPY? Your other, 2,000 plus stocks, or really for the QQQ, I guess, the other 90 or so stocks that are not the 10 largest stocks. They have done really, really bad. Take a look at a PayPal and a Square. PayPal and Square are trading lower than their Roni crashes. Square is right at about that level. PayPal is way under its Roni crash. At the Roni crash, it was $80. Today, it's $50. These charts look like basically 95% of other stocks on the broader markets. That's why a lot of people, this is like the most hated bull market ever, because just nothing has really done well. That has to do with liquidity, but with the money that was already in the markets, you've just seen people rush to the safety stocks, which are perceived as big tech, and sell basically everything else. So even though you really didn't see much, inflows to the markets, $2 billion is like chump change, okay? You've just seen the money just move around. That's what's happened. Investors are not actually buying stock. That is the most important thing that you can actually pull out of this whole video. Nobody's buying stock. Well, how do stocks go higher? You might ask, right? That's just a logical question. The market makers, they're the ones that hold the market. So in a stock like PayPal, a stock like Square, nobody wants to own them. So they go lower. True. Market makers, they don't have anyone to sell the stock at higher prices to. So they just kind of stay where they are and trend downwards. And I'm just picking on these guys because they're so beaten down. Your other stocks are beaten down too. They were just easy examples. Whereas if you look at something like a big tech name, they haven't been affected by interest rates. They've actually been benefiting from the Fed raising rates, bringing in more money because they have $50+ billion of cash on their balance sheets. They're bringing in billions of dollars every quarter because the Fed's been raising rates. They don't have to refinance debt or even issue debt. They're self-financed. It's been the obvious place to hide out. But even those stocks have really not done much over the past 2 years or so. Again, because nobody's buying stocks and there's no liquidity. And if you actually take a look at this post from the short bear, I just find it crazy. Just wild. PayPal, back during, those times during the Rona recovery, before the Rona, PayPal was doing about $2.97 billion in revenue every quarter. Their last earnings, they did $7.29 billion. They've increased their revenue over 100% in the last few years. Square is even way more impressive. Square was doing about $282.5 million of revenue back pre-Rona. And now they're doing $5.53 billion of revenue in their latest quarter. Just nobody has been buying stocks. That's the problem. So it looks pretty obvious to me. What's going to happen over the next couple of weeks? You've already seen it start. And that is really your big tech stocks getting that flush out of liquidity like you have seen with small cap stocks. Now, I don't think it's actually going to leave the markets. And I think Tesla in specific is in a very interesting kind of middle ground here. And I think Tesla, you could have a huge opportunity to buy the dip and then subsequently potentially see Tesla at $500-$600 or more by the end of 2024. But I think your flush out of big tech is coming, and Apple this week is going to be important. That is on Thursday. The Fed on Wednesday is going to be very important as well. The Fed, I'm expecting the same old. I'm really not expecting anything different from the Fed. Probably a little bit more hawkish than we're used to, and this could help kind of draw out this liquidity even more. Maybe they're more dovish. Who knows? Really hard to say when you're trying to predict the Fed. There's actually, for the first time now, a 2% chance of a rate cut coming on Wednesday. It's obviously not going to happen, but it's the first time we've priced in a rate cut rather than pricing in a rate hike. There's zero chance of a rate hike. There's a 2% chance of a cut. So maybe that means the Fed's going to be a little bit more dovish. Again, that's probably a topic for another video. But here in the next couple of weeks, my opinion, your indexes, your big tech is going to fall like a rock. That money's probably not going to leave the markets, or most of that money is not going to. There's obviously another alternative. There are treasuries. I expect treasuries probably are going to start getting some inflows. That probably brings down your treasury yields. When people buy treasuries, yields fall. When people sell treasuries, yields go higher, as you can see with this chart of TLT, right? People sell treasuries. What's happened over the past 2 years? Yields have went higher. If people start to buy TLT, buy the treasuries, yields will go lower. It's opposite, right? This is probably going to have a big benefit to your small mid-cap stocks that have had zero liquidity, zero appetite for investment. And that's because 2024, it looks clear to me. The next move from the Fed is a cut rather than a hike. And the markets are forward-looking. So they sit here and they say, hey, where do we want to be positioned in 2024 that's going to benefit from the Fed? Well, it is small and mid-cap stocks. It is something like a Tesla. Who's not going to benefit from the Fed cutting rates? Well, your big tech stocks. So it's clear. Why did big tech do well in 2023? They benefit from the Fed raising rates. A cut looked so far into the future, it was ridiculous. Well, now it's a different story. Now I think small cap stocks are going to start doing a lot better. And obviously, it's not going to happen all in one day. It's going to take a while until the markets, finally get that narrative of maybe we want to be in these beaten down dog stocks, quality ones at that. Tesla's kind of playing both sides here because Tesla is a big tech name It is a stock that's down 50% from its all-time highs, but it is a stock that's up over 100% from its January lows. So Tesla's probably going to follow what the indexes do. Tesla stock might get clapped over the next couple of weeks if the indexes continue to fall, in which I'm firmly, strongly expecting that they will. So Tesla could fall quite a bit. But Tesla is, again, playing that other side, because Tesla is by far, off my memory, top of my head, the biggest beneficiary from the Fed lowering rates. So you might get an opportunity where maybe Tesla trades down to 150, maybe lower than that if the indexes fall a lot. But then the markets are going to realize in 2024, Tesla's raising prices. Tesla's margins are improving. Tesla, if you're trading at a 50 times forward PE right now, maybe in 2024, Tesla's actually going to be trading at like a 30 times forward PE, because Tesla raises prices $10,000, $15,000 on some of their vehicles, because it's all about that monthly payment. Nobody gives a crap if they're buying a $100,000 car for $500 a month, or they're buying a $30,000 car for $500 a month. Nobody cares. Mark your price. Tell me what the monthly payment is. That's what people care about. Everyone would buy a $250,000 Lambo if it costs $600 a month. It costs $6,000 a month, so they don't. Really, it costs like $3,000 a month. You get the point, okay? So Tesla can raise prices and keep the monthly payment the same, if not lower, when the Fed actually, lowers rates. So Tesla's margins going to see a big improvement. And the valuation might actually be stupid cheap in 2024 if that happens. And I think, again, markets are forward-looking, so the markets are going to sit here and already price that in. So by the time, this video actually comes true, Tesla's stock could be in the threes, right? It could be much higher than where it is today. And that day that the markets figure that out is going to be a day everyone wished they were buying the dip in Tesla. And then just to kind of put the icing on the cake here, or the cherry on the sundae, Tesla is very under-owned by Wall Street, and I think that does change when people realize who's benefiting from rate cuts, who's benefiting the most, who is the highest quality, or what is the highest quality you can buy that's also benefiting the most from the Fed lowering rates. It's Tesla. I can't think of another stock that would benefit more from the Fed cutting rates with the same degree of safety as Tesla. Name me one down below in the comment section. Name me one. I challenge you to name me one stock that is higher quality, and what I mean by that is like less of a chance of going bankrupt, just higher quality, and that benefits more than Tesla. I doubt you can do it. Matter of fact, if someone actually does, I will hook you up, okay? Let me know. So, that's really my conclusion here. Whether it's the Fed, whether it's the Middle East, whether it is, data, whether it is, recession, who cares? The markets are coming down over the next couple of weeks. In my personal opinion, again, I make strong assessments. I'm not a financial advisor. I'm not a financial planner. It's logical, okay? Don't listen to what I say. Don't invest based off what I say. None of this is personalized financial advice. None of it. The markets, S&P, usually returns 7 and 9% every single year. Take that information and run with it. That's your historical performance. That's what a financial advisor will tell you. I am not one, so don't listen to me. But I think you're probably going to get a flush out of your markets, big tech, and then you will see everything do well, but it's not going to be your leaders that you've seen in 2023, at least in my opinion. Tesla stock could easily be $500-$600 a share next year if things go as I think they will. And another thing I want to point out is Elon on the last earnings call already preconditioned us for the Cybertruck to be a drag on Tesla's business for the next 12 to 18 months. What if it's not? What if it's not as bad as Elon thought? Elon just set you up with a big catalyst for 2024, potentially. So that is going to do it for this video. Again, my levels on Tesla I'm watching is 180 seems almost certain. 150 is about 50-50. 130 or lower is probably around 20%, maybe less than that. I'm not confident we're going to get down there. I think Wall Street will figure out if we do go through uncertain times and the Fed does cut rates, well, Tesla's going to benefit a lot from that, and Tesla's probably going to raise prices. I don't think it's going to take that long for Wall Street to figure it out, but Tesla will fall with big tech, at least for a while. So that's going to do it for this video. Hit that like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. If you guys would like to come trade with me live in real time, if some of this information makes sense, well, maybe you want to come grow that information and knowledge a little bit more. Different trading strategies. We do it all. YOLO, swing trades, day trades, earnings trades, passive income, spreads, butterflies, iron condors, calendars, all kinds of different things. If you guys want to join it, link down below in the description of this video. Thank you for watching. My name is Michael Tyler. Enjoy the rest of your day and night, and I will see you in the next one.